In 2004 and 2005, Michael Burr identified an overvaluation in the mortgage market, observing that high-risk loans were likely to lead to a real estate crash and potentially harm the U.S. economy. As the head of Scion Capital, a hedge fund he had earlier founded, Burr acted on his insight by betting against the mortgage market in 2007. His prediction was accurate, and the ensuing market collapse resulted in a profit of over $100 million for him. With current discussions around economic challenges and potential downturns in 2024, such crises are typically viewed with dread, associated with job losses and financial instability. However, for those with wealth, knowledge of the financial system, and investment acumen, these periods represent rare opportunities to achieve substantial financial gains, often seen once a decade. This narrative introduces the Big Short as a strategy among 4 lucrative approaches to capitalize on during a crisis. While buying low and selling high is a well-understood concept in the stock market, short selling offers an alternative path to wealth, especially during economic downturns. By borrowing and selling a stock like Apple at $100 and repurchasing it at a lower price, say $60, investors can profit from the price difference. This technique exemplifies how strategic investments during crises can yield significant returns. Imagine you made $100. If in a month, a stock drops from $100 to $60 as you guessed, you can buy the stock back for $60, return it to the broker you borrowed it from, and keep $40 as profit. This way, you've made money from the stock falling without using your own cash. This sounds good, but it's risky because if the stock price goes up, you could lose a lot of money. However, this can be a strong way to get richer when times are tough. For example, in February 2020, if you thought a virus would cause a lockdown in the US, you might decide to bet against the market. When the market did fall, some people, like hedge fund manager Bill Amann, made a lot of money. He made $2.6 billion when the market went down. In 2001, when tech stocks were too expensive, Michael Burr's fund made a 55% profit by betting they would lose value. Even when the market did well in 2003, Burr's investments gained 50%. Another strategy involves the Federal Reserve, which tries to stop the economy from getting worse by changing interest rates. During bad times, the Fed cuts rates, sometimes to 0 or below, making it cheaper to borrow money. This can affect banks and the economy in big ways. Imagine a situation where banks actually pay you to borrow money, which might sound crazy, but can happen when the economy is struggling. People usually keep their money close and avoid spending or investing during tough times. Negative interest rates are used to encourage spending and help kickstart the economy. A smart move is to use these almost free loans to buy out competitors who are having a hard time. This way, once the economy gets better, you could control a bigger part of the market, easily pay back the loan since it had little to no interest, and end up much richer. Some people even use these loans to invest in the stock market when it's at its lowest. Then, when things improve, they sell their investments, pay off the loans, and keep the profit. While this might seem harsh, it's all about staying ahead in business. However, the downside is that this strategy often doesn't help the less wealthy, who may not understand how to use these economic tricks or are too worried about their future to take a risk on a loan. In 2008, during the mortgage crisis, many people lost jobs and homes, while some company leaders got huge bonuses. This situation showed many the value of having different sources of income. However, for the average person, the stock market can be a tricky place where it's easier to lose money, especially when broker fees for transactions are high. Back in 2008, trading stocks was expensive because you had to pay your broker around $5 to $15 per trade. For big investors making lots of money, this fee was nothing, but for beginners starting with just a few $100, $10 a trade was a big deal. This issue inspired Vladimir Tenev and Baiju Bhatt. Motivated by the financial crisis, they launched Robinhood in 2013, a trading app that didn't charge any commission. This meant anyone could start investing with just a little bit of money right from their phones. It was a game changer, making it easier for a whole new group of people to invest in the stock market. Robinhood's popularity soared, attracting millions of users and reaching a valuation of $8.7 billion in its last funding round. This success made its founders billionaires quickly. Crises often lead to new problems that demand innovative solutions. which can turn into highly successful businesses. Wealthy individuals look for these opportunities, either by solving problems themselves or investing in those who do. For example, the pandemic sped up vaccine development, with one being created in just 42 days and forced companies to adapt to remote work and improve delivery services. These changes have lasting impacts, showing how crises can speed up the use of new technologies and transform industries. During tough times, certain technologies become super important. The COVID-19 pandemic showed us how much we need things like video calling, online shopping, and digital health services. Smart investors watch these trends closely, putting money into businesses that are ahead in these tech areas or starting their own through new companies or teamwork. When everyone had to work from home, there was a big jump in money going into tech for remote work, online doctor visits, and online classes. These technologies can grow quickly to meet higher demand during a crisis, and companies that can change and grow fast often do really well. After the crisis is over, many of these tech solutions become a regular part of life. Tools for working from home like Zoom or Microsoft Teams became key during the pandemic and stayed popular even when offices opened again. Tech like AI and big data help businesses make smart choices based on data, which is really helpful when things are uncertain. Automation can also cut costs and keep things running smoothly when it's hard to have lots of workers around. Investors and businesses leading in digital change gain a lot, from financial tech during economic lows to AI in managing delivery problems. The main point is that for those who know where to look, a crisis isn't just a problem, but a big chance. The stories of Michael Burr betting against the market, the start of Robinhood by Tenev and Bot, and the quick move to digital tech show a common idea. It's about looking at things differently and finding opportunities when times seem tough. As we wrap up this insightful journey through navigating crises with innovation and strategic investments, it's clear that challenges can indeed transform into opportunities with the right perspective. From Michael Burr's astute market bets to the revolutionary inception of Robinhood and the swift digital adaptations during the pandemic, each story underscores a powerful lesson. Adversity can fuel extraordinary success for those prepared to see beyond the immediate turmoil. What challenges have you faced, and how have you adapted or innovated to overcome them? Share your stories in the comments below to inspire and learn from our community of forward thinkers. And if you found value in our discussion today, don't forget to hit the like button to support our content. Subscribe to stay updated with more weekly investment insights and tips designed to help you navigate the ever-changing financial landscape. Thank you for watching, and here's to finding opportunity in every crisis. Happy investing! See you in the next video.